What is fiat? Why don't we just call it money? So fiat money is government-issued currency that is not backed by a physical commodity, such as gold or silver, but rather by the government that issued it. The value of that money is derived from the relationship between supply and demand and the stability of the issuing government, rather than the worth of a commodity backing it. Most modern paper currencies are fiat currencies, including the US dollar, the euro, other major global currencies, including Ghana cedi. Okay, let's backtrack for a second. The term fiat is a Latin word that is often translated as "it shall be" or "let it be done." Thus, fiat currencies only have value because the government maintains that value. There's no utility to fiat money in itself. Currency came about when governments would mint coins out of a valuable physical commodity such as gold or silver, or print paper money that could be redeemed for a set amount of a physical commodity. Fiat, however, is inconvertible and cannot be redeemed simply because there is no underlying commodity backing it. Advantages. Fiat money serves as a good currency if it can handle the role that a nation's economy needs for its monetary unit. Strong value, providing a numerical account and facilitating exchange. It also has excellent signage, meaning it's more cost efficient to produce than a currency directly tied to a commodity. Since fiat money is not a scarce or fixed resource like gold, central banks have much greater control over its supply, which gives them the power to manage economic variables such as credit supply, liquidity, interest rates, and money velocity. For instance, the US Federal Reserve has the dual mandate to keep unemployment and inflation both low. A currency tied to gold, for example, is generally more stable than fiat money because of the limited supply of gold. There are more opportunities for the creation of bubbles with fiat money due to its unlimited supply. Example of fiat money gone wrong: hyperinflation. The African nation of Zimbabwe provided an example of the worst-case scenario in the early 2000s. In response to serious economic problems, the country's central bank began to print money at a staggering pace, resulting in hyperinflation. Experts suggest the currency lost 99.9% of its value during this time. Prices rose rapidly and consumers were forced to carry bags of money just to purchase basic supplies. At the height of the crisis, the Zimbabwe government was forced to issue 100 trillion Zimbabwe dollar notes. Eventually, foreign currencies were used more widely than the Zimbabwe dollar in itself. So the key takeaways from this is: fiat money is a government-issued currency that is not backed by a commodity such as gold. Fiat money also gives central banks greater control over the economy because they can control how much money is printed. Most modern paper currencies such as the US dollar are fiat currencies. One danger of fiat money is that governments can print too much of it, resulting in hyperinflation. What are stablecoins and how do they fit into the crypto space? Okay, so as with any emerging asset class, cryptocurrencies are susceptible to market forces. Accordingly, many crypto projects are actively exploring ways to reduce risk and bolster participation in the broader crypto ecosystem. Current solutions go well beyond the buy, sell, and stop orders of conventional markets. Instead, price stability is being built directly into the asset themselves. The result is an entirely new subset of the cryptocurrency market known as stablecoins. These tokens are meant to function the way their name suggests, with stability. Stablecoins offer a way to bridge the gap between fiat currencies like the US dollar and cryptocurrencies. Because they are price-stable digital assets that behave somewhat like fiat but maintain the mobility and utility of a cryptocurrency. Stablecoins are a novel solution to crypto volatility. Price stability is built directly into the assets themselves. Stablecoins can be classified into different categories, primarily on the basis of assets that are supporting them. A quick reflection on the different types of stablecoins should help you better understand the foundation for stability in stablecoin prices. There are generally 4 accepted categories of stablecoins. 1. Stablecoins backed by a commodity. Stablecoins that are pegged against commodities generally have the backing of hard assets for stability. The hard assets could include real estate or gold. However, the most commonly used hard assets for collateralization of stablecoins is gold, with many stablecoins using a diversified collection of precious metals. Stablecoins backed by crypto assets. While many would argue against stablecoins being pegged against crypto assets, crypto-backed stablecoins have a different picture to paint. Such types of stablecoins are often capable of maintaining an over-collateralized position. 3. Stable coins backed by fiat currency. You would also come across fiat-backed cryptocurrencies as the most commonly accessible stablecoins. They are very popular, and as the name indicates, such types of stablecoin have the backing of fiat currencies such as the US dollar, euro, or Chinese yuan, which are kept as collateral. They are also very widely known as CBDCs, or central bank digital currencies. So 4, stablecoins backed by Signorage. Signorage is generally under the governance of an algorithm or a process in comparison to a currency or asset. In this case, smart contracts on decentralized platforms can serve as independent supporters for the Signorage-backed stablecoins. The most immediately apparent advantage of stablecoin technology is its utility as a medium of exchange, effectively bridging the gap between fiat and cryptocurrency. By minimizing price volatility, stablecoins can achieve a utility wholly separate from the ownership of legacy cryptocurrencies. As their name suggests, stablecoins are inherently stable assets, making them a suitable store of value, which encourages their use in everyday transactions. Further, stablecoins improve the mobility of crypto assets through the ecosystem. Stablecoins point the way towards integrating traditional financial markets with a quickly evolving decentralized finance industry. As a force for market stability, stablecoins present a primary vehicle for cryptocurrency adoption in loan and credit markets, while inheriting much of the utility previously reserved for only fiat currencies.
NFTs are an exciting new phenomenon in the tech space. It's an acronym for non-fungible token. It simply means an item is unique. In another video, we'll look at what the term fully means and how you're able to identify non-fungible tokens and fungible items. Not to take away from what this is, a bit of an explanation. So a non-fungible token is a type of digital token that represents a unique asset and can be an entirely digital asset or a token version of a real-world asset. As NFTs are not interchangeable with each other, they function as proof of authenticity and ownership in the digital space. So Binance, my favorite ecosystem of crypto services and apps, has just recently launched the Binance NFT Marketplace. And it features all forms of digital artworks and collectibles. It's powered by the Binance blockchain infrastructure and the community within the space. The Binance NFT Marketplace provides the highest liquidity platform for users. The marketplace brings together artists, creators, and crypto enthusiasts on a single platform. The platform has 3 main features. 1, a marketplace. It allows you to mint, sell, bid, and purchase NFTs from creators around the world. 2, events. It allows you to buy premium and exclusive NFTs from leading creators and influential names and brands. Events include offerings from digital artists, musicians, as well as athletes and celebrities. 3, mystery boxes. Each mystery box is guaranteed to have at least 1 random NFT inside, often for a chance to win a normal, a rare, a super rare, or a super rare NFT. So to get onto the Binance NFT Marketplace, it's not a different app. It's right within the Binance app that you already have. Getting started, like I always say, is pretty easy. First and foremost, you need to already have a Binance account. If you don't have a Binance account, you can check the link in my bio. I have walkthroughs for how to set up a Binance account. I have a direct link for you to set up your Binance account directly. The second step you need to make sure you have sorted is to make sure you've completed your verification. You'll be required to have at least some level of KYC sorted out so that you're able to transfer that amount or that value of crypto to be able to make those purchases. 3, deposit or buy crypto. If you don't know how to do this, I have other videos in on my channel that you can check on how to buy cryptos with either your credit card or debit card, or how to buy it if you're in Ghana with mobile money. And then 4 and final, trade NFTs on the Binance NFT Marketplace. A few questions that come up often when people start out in the NFT space, especially on the Binance NFT Marketplace. Question 1, how do I get an NFT account? Use your regular Binance account to access the Binance NFT Marketplace. I'll leave a link to the Binance NFT Marketplace in the first comment. If you don't already have an account, I've already spoken about how to get an account. You can use the link in my bio, and it will just walk you through very, very, very quickly. Number 2, which cryptos do I need to buy or trade NFTs on the Binance NFT Marketplace? Binance NFT Marketplace allows you to use BNB, BUSD, and Ethereum to trade on the marketplace. 3, can I deposit and withdraw my NFTs? Yes, you can. If you already have your NFTs, you can do that. You can deposit them on the platform and you can list and sell them as you see fit. 4, can I mint NFTs on the Binance NFT Marketplace? How can I create or list my own NFTs? So in the meantime, since the NFT Marketplace came on, the minting feature is only available to select Binance artists and partners. In the near future, all Binance users will be able to create and mint their own NFTs. And 5, do I need to complete identity verification before I can trade NFTs? Yes, you actually do need to complete your KYC and your identity verification before you can trade NFTs. Now, the main reason being that NFTs have a lot of value and are seeing a lot of value in this space. So you find, you may purchase an NFT for about $10, and then the next day it's worth, $5,000 or $10,000, and you want to cash that out. You're still going to have to make sure that your verification is complete. So before you start in the NFT marketplace, make sure to have at least completed the first level of your verification on the Binance app. If you happen to need any other help, you have any other questions, you can leave them in the comments. I'll do my best to answer them. If you don't have a Binance account and you need to get a Binance account, as I've mentioned before, check my bio. I have links, I have training videos there.
Crypto terms. 2 of my favorites. There's HODL and there's DYOR. Very important terms, but very commonplace. You come across them in your entire crypto journey as you go along. Let's start with the easy one. DYOR. It simply means do your own research. There are a lot of gurus out there, and they're going to be telling you all kinds of things. If you're lazy, crypto is not for you. If you cannot make the time to read and find out what a token means or what a project is about, crypto is probably not for you. Because then otherwise, you're only going to be chasing after get-rich schemes or people who are prophesying and telling you amazing stories about how quickly you can double your money. Selling you snake oil. That stuff doesn't work. You're going to have to make the time to learn how to do your own research, because you're going to be investing money and you want to be sure that the money that you're investing is in line with your own ideologies and your understanding of what is important for the future. The second term is HODL. I like to call it diamond hands. Very exciting. So in the crypto space, there's a lot of exciting things happening. There's a lot of news which makes a lot of tokens fluctuate and things go up and things go down and prices are all over the place. But you need to understand that the key to winning in crypto is holding the most promising assets for the longest period. Let's have a quick analogy. So let's look at Bitcoin. If you bought Bitcoin when it was less than $1 and bought pizza with it, you would have lost out. You couldn't hold. But if you bought Bitcoin when it was less than $1 and you held on up until it was $8,000 and you sold, you would have made $8,000. But if you continue to hold on till today, you will be upwards of $50,000. You get my drift? So essentially, HODL means to hold onto a token or an asset, a crypto asset that you fully believe in for the longest time possible. You can trade it and move it around and take your profits. But the most important is to understand that it's well worth its weight in gold. And so what that means is that you want to hold on to it as long as you possibly can.
been asked a few times what the best crypto token to buy and hold for the long term is. There isn't a best token. Yes, there's the original Bitcoin. There's Ethereum. There are a few of the originals that are great to buy and hold. But each token essentially has a utility. And this utility determines long-term how the token or the coin is going to perform on the market, and even as a crypto token, and in doing what it's supposed to do. So there isn't a best token out there. Absolutely, do buy some Bitcoin for the long term. You don't. It's digital gold. Buy some Bitcoin and hold.